Hello, everybody. Welcome to Prairie Fire World Headquarters here in the south side of Des Moines. We're happy to have you today. We'd like to, every quarter, as you know, talk about markets and give a little update. We're halfway through the year here. We've been facing a rather balmy and tumultuous summer weather-wise here in Des Moines, and we've also had a tumultuous spring and coming into a somewhat of a calm summer that may not prove to last. So we wanted to update everybody on what's been going on out there. We'll talk about a broad range of issues, but it's been quite a wild ride. How's your summer been going, Will?
It's been hot and there's been a lot of just stuff going on. I mean, I can't believe it's already the end of July, but then at other points, I'm like it's only July. Just been just so much going on this year. It's hard to believe.
Gone fast.
Yeah.
Had a good trip to Oregon.
Good trip to Oregon. Survived. Didn't see any bears. I need a break from camping, so I'll be in the bed for a while. Not in the sleeping bag.
I always tell them the story of how I used to camp with my buddies, and now we all stay in our own rooms at hotels. So the times change as you age, that's for sure. So, all right, we've got quite a few joining us today. I will open up the Q&A in the chat, so if you have any questions, comments along the way, we'll be checking those. Most likely address most of those at the end. But Will, why don't you kick us off? What's going on out there?
Well, it's mainly been. We've had 3 really good years in a row, and starting early in 2026, it was looking, bright for another 4th strong year in a row. And then the whole skirmish with Iran started. That kind of threw us for a loop for a couple of months. As everyone knows, price of oil skyrocketed. Gas prices have been high for most of the spring and into the summer. Driving inflation up, which we're going to talk about here in a second. But then, after the market lows of the war, we've had a really nice recovery, and I'll talk about why here in a little bit. But let's start off with what's on everyone's mind. It's always in your face, and that is inflation.
Yeah, so I think a lot of our story this year and back to even 2022, maybe even to COVID, has been around this issue. I was looking back at some of the data from 2022. And if you remember that year, we had severe spikes in inflation across the board. And you can see it in the middle of this chart. And I was curious as to what actually happened with interest rates, because I think it's going to play out to what may happen to us in the future, hopefully nowhere near those extremes. But tells a story, and it's going to infiltrate all parts of the economy. And so if we remember back then, we had obviously inflation spike, a lot of energy prices go up, all of that. And the Fed raised rates 7 times that year, just to give you some reference. So we were at 1/4 of a point, they went up to 4.5% in that year. So 7 hikes, which in today's environment seems crazy because we don't see them move around anywhere near that much. We've had some turnover with the Fed chair, all those kind of things. But as we've seen inflation moderate, come back down to near levels, during all of this time, back to even the beginning of this chart, prices are going up and they move around. Sometimes it's energy, sometimes it's shelter and home services. Sometimes it is insurance, whatever the case may be. But across the board, prices keep going up. So things continue to cost more. What we haven't seen then is a lot of wage increases to support this. And so it really is a drag on the economy. And what the back end of this and where this all leads us then is to what's going to happen if inflation continues to persist. Now, in June, we saw it come down primarily because of energy. And if you see this chart, it goes up back to May. And the green part is energy and how that spiked. And we all know why with the Strait of Hormuz issues and what was going on in the energy markets. It did come down now as we've seen some more recent dust ups. I was just in North Carolina. Gas was about $3.25. I get home, it's back to $4. And so I think it's not a North Carolina, Iowa thing. I think it's actually we're seeing them go back up because of what's going on with the continuation of the Iran conflict. So inflation itself and what's going on in that part of the market, I think is going to really tell the story of where this goes as far as the overall economy. Because if inflation and prices keep going up and wages don't follow those, Social Security benefits don't go up at the same level as inflation, we could definitely see a beginning of a stagnation of the consumer. And the consumer really drives our economy, keeps things moving. So The other thing then is how this is going to impact the Fed and interest rates. So like I said, in 2022, 7 hikes. At the beginning of this year, Will, guess what the market was saying as far as how many rate cuts we were going to have this year?
Probably 3 or 4.
Yeah, a lot of prognosticators were saying 7
Oh.
interest rate cuts, just like we had, which would almost imply a recession because we're trying to stimulate activity so much. So that's crazy to me. Well, the tide has flipped, and now the consensus is really at least 1 rate hike coming up before year end, and no talk at the moment of rate declines or decreases. And so when we look at what the market expects for interest rates, what the FMOC, the federal market, is saying as far as what they're going to do when it comes to interest rate changes, we're really seeing that line begin to stagnate. And if I could draw a line here, I would extend it out with kind of a little bit of a bell curve where we could possibly see rates go back to where they were. And we talk a lot to young investors and young families, and they're always asking about interest rates for mortgages and things like that. I just don't think we're going back to the years of flat to zero like we had in these early years of the chart. I think it's definitely going to stay pretty close to that. So this tells a big story, and this is an area that we're watching very closely because it is going to impact investments. It is going to impact the economy. The crazy thing with all of this, with rates going up, inflation going up, is the stock market keeps killing it, Will. It keeps going on. So tell me, why is that? Why do we keep seeing the stock market be so resilient?
Yeah, well, it definitely hasn't been a straight line up. We've definitely had our moments, some hiccups along the way, but so far year to date, the market's almost to double-digit returns already here in July, and that's been primarily due to super strong earnings across the board in the first quarter of this year. So if you look to the chart on the bottom, it might be kind of small for you guys, but the leader there is energy, and they're at their expected earnings per share growth for 2026 is almost 82%, followed by technology, which is somewhere in the 60s, and then it moves on down. But a lot of those sectors are double digits, which is really good to see. The great first quarter we had is expected to continue through all the rest of this year. We're just kicking off earnings season for the second quarter, and the companies that have reported thus far, it's been all good news. So if this continues, I think we could see pretty decent 2026, barring anything extreme, or if inflation finally gets hold of the consumer and they really slow down on their spending, we could see this fall apart a little bit. But as it sits today, companies are healthy and earning lots of money.
Why don't you think they care about what's going on in Iran? It seems like such a big deal. There's a war going on out there. We've got the Ukraine war continues. All of these kind of geopolitical upsets haven't seemed to end over the last number of years. Why do you think the market continues to persist despite those?
I just think since those wars, for us here in the States, those wars are just so far away, and really the only impact it has on us financially is higher gas prices, but everything else here is just normal, I guess. Companies are still operating in normal capacity, so I think that's kind of why you're seeing companies over here in the U.S. Do just fine. And then this slide just kind of reiterates my point. Super strong growth over the past couple of years and into this year. Margins have grown over the past number of years, so companies are able to do a lot more with a lot less money, and that's thanks to partially AI, just businesses growing, finding inefficiencies, and creating new ways of doing things that cost less money. And that's expected to continue. The two dark green bars on the right show that this is projected to continue as well. That's what's going on in the States. Starting last year, we talked a lot about international stocks. International companies outperformed U.S. companies last year for the first time in about 15 years. They did about double what the U.S. did. So I'm curious to hear your thoughts on what's going on across the pond.
I've been curious about this because the performance of a lot of the companies in Europe and Japan and even in the emerging markets haven't been stellar, and they don't have any exposure to what I'll call kind of the AI trade that we've seen here with the Magnificent Seven domestically, the build out of data centers, the energy infrastructure rebuild, a huge growth in our services economy. That hasn't been the case. There isn't a lot of technology spending comparatively to the percentage that we spend here, and that our companies like these hyperscalers like the Metas and Googles are spending on AI and all that. That's not happening in the other parts of the market. But what they are doing is rebuilding the core of their countries, and they're rebuilding their ability to be independent. So the deglobalization that has started many years ago is filtering into the rest of the world. And so you combine that with a dollar that's declined ever so slightly, and prices that are just a lot less expensive in their markets. These charts that I put together here for you basically shows the global equity valuations compared to the US. And nearly every sector except healthcare is priced precipitously, or quite a bit, I'm being a little hyperbolic, quite a bit below its US counterpart. So you're basically getting a company that can function in the, call it the energy space or the communication services or a bank. And they're able to do that with a lower price dollar, and their stock is trading at maybe 2/3 of what a U.S. counterpart is. You combine all that, you got a little bit of a perfect storm for a good little lift along the way here. So I've been interested to see this. We've been waiting 15 years. Back to my days at Morgan Stanley, they were banging the table that we were going to convert to international outperformance. This is the first time that we've seen it. I still believe, and I can show you charts that prove it, we're by far the biggest player in the market, and the U.S. market is going to drive a lot of the performance in other ones because of the breadth of what we do and the amount of output that our country puts together. But they have been playing a little bit of catch up here. It's been nice to see. I've always believed diversifying internationally is a great way to protect portfolios, and it's nice to be rewarded for that now with actually growth and performance. So I'm thinking about it a little bit like a bell curve, in that I'm seeing it emerge. I think we're beginning to flatten out a little bit here, and we could see a little bit of that performance catch up and slow down, because once again, we're not seeing enormous growth out of these economies, and you have to have that. The exception would be Japan, where we've seen a real reemergence. Finally, they've been 30 years in the doldrums, recession, a huge demographic aging problem, or just dynamic in the country that's beginning to change. And so it presents an interesting opportunity set. We definitely want to be there. We want to make sure our clients have exposure to that. We are treading lightly because we do want to see if it's for real and if there is earnings and stuff to support that. So, all right. We're going to talk a little bit about bonds, and we usually focus a lot on stock markets on these calls because it's a big deal. The bond market is also an enormous market, and one that, if we go back to my first slide in our first part of the conversation, I think is going to have a lot of headwinds. And so I think that will. What do you think? Where do you think we go from here?
I agree. I just checked what the ag was doing before we hopped on this call. Year to
Tell them what
date,
the ag is.
just an index of bonds, and it's flat for the year. It hasn't done anything, and bond prices do well when interest rates go down. Bond prices and rates have an inverse relationship. So when rates go up, bond prices go down. And with where inflation is, with where rates are, with us not seeing any room for them to cut or any need to cut, I think bonds are just going to continue on this kind of sideways year of doing nothing. And so while we don't think bonds are particularly attractive, we just want to make sure we're not abandoning the bond market. We just want to make sure that we're flexible, using, instead of picking our own bonds, using a couple different funds that can go long in maturity if they need to, or stay short. There are a lot, professional bond pickers that can do that a lot easier than we can. And then we're also always looking for alternatives to bonds that provide the same sort of stability that someone in the bond market wants, but hopefully can yield a little bit better return than bonds are right now. And we're also looking for alternatives in the equity space too. So as a reminder, an alternative is just an asset class that's going to behave differently than stocks or bonds. So it's another great diversifier. So something we're always looking to add to.
We think that diversification is so important. In the past, it's been so easy to get that in the bond market. We knew we could go to bonds for safety. 2022 proved us, and that theory can be definitely blown out of the water with rising rates. So we have to have the ability in our bond portfolios to get the flex that we need that comes when rates are going up. And so convertible bonds, some of the hedged equity that Will talked about, alternative ways, is something that we're very, very focused on here and working on. And so you will very likely see changes in your portfolios over the next number of months, and they'll be focused in this area. We're trying to take advantage of what we think is going to be we want the safety that comes from, we want the ballast in the portfolio that helps us diversify away from pure equity and stock risk. And we feel that we can definitely find ways to do that, but it won't be buying passive bond indexes any longer. We don't think that's going to provide the protection that our clients need. So that was a good explanation. Well, thank you. What? There's an election coming?
I was going to say, did you know it's a midterm election year? If you haven't noticed, but we've been getting a lot of questions, and we always do around election time, whether it's a midterm or primary. Are we making any changes depending on who wins? Should I invest in this? If Democrats win, should I invest in this? If Republicans win, what are we doing with client portfolios when it comes to the election?
Yeah, we've done a lot of historical look back for midterm years in particular. And historically, I think we've seen markets have done right around 4% average with a lot of volatility in the summer and the fall. And so I would just brace all of you for that. So no, we won't make changes based on just the election itself. What we'll be looking at is what the output of that election could become as far as policy looks like. But historically, it hasn't served clients well to make big changes because of political meanderings. And midterms are going to be one of those. There's going to be a lot of noise around this one. It's obviously an incredibly toxic, loud environment that isn't conducive to making great investment decisions. We're more interested in what's going on with the underlying economy, what the Fed is doing, what's going on overseas, and how all that's going to impact the investment and economic returns here domestically. So that all goes into our thinking. We try not to get into the weeds politically as far as one seat this drives this for economic policy. Will one lead to impeachment? All of those kind of things will happen in a certain way, but we've never seen a historical metric that serves well to say get out before a midterm and get back in after in any reasonable way where it would be profitable. Every change creates opportunity. What we've seen in these markets that's been very common to bull markets where it keeps going up is capital keeps chasing resources that already have it. It doesn't chase scarce capital. That's when money is really made over time in markets, is when money goes where it's really needed, where it can really make assets grow. That's why we believe so much in infrastructure. And I've been talking about it because we think that is an area that's somewhat scarce of capital and growth and has the ability to grow over the next number of years. AI is one where all the capital is going. The SpaceX IPO proves my point. And that's not purely AI, but definitely where there's a lot of hype and noise. And so we are looking to make sure that when we're looking at our sector allocations and our overall broad market stuff, we use a lot of BlackRock as intellectual capital here when we do this to say where might there be opportunities. We also listen a lot to Richard Bernstein advisors and that team because they've been very, very good at seeing where the puck is going and how to get yourself safe in whatever environment may come for that range of outcomes. So we're bringing in a lot of intellectual capital. The beauty of being independent is that Will and I can do that. We can pull resources from wherever we need to get the best outcomes for our clients. And so keeping that broad, longer term view is going to be important as we go through this election year and in 2 years again. But the bigger issue is what's going on in the economy, which so far appears to be pretty solid. What's going on in the bond market? Rates appear to be stable for right now. What's going on with inflation? It's up slightly. We'll have to see what happens there with the war and those kind of things, but really encouraging clients to not let the noise distract them from making good decisions. And I don't question, I understand how hard that is to do. I watch the news every day. My drive-in every day is CNBC listening to some AI guru talk about, where the world is heading or and then some senator that comes on that says it's going to hell. So I don't know. I don't ever quite know what to believe, but we have to parse a lot of opinions to make sure that we're delivering the best advice that we can. So let me see. Any questions out there? You can throw them in the chat or the Q&A. Not seeing anything yet. Anything you're looking forward to this year at the Iowa State Fair, Will? I know you're a huge fan.
Just the food. I just hope it's not 1,000 degrees like it is every single year. Hopefully this year I don't get triple parked in the parking lot. Last year I pulled behind somebody and then someone parked behind me. So I was in between two cars and Croto had to come out and move the person that was behind me. So hopefully that doesn't happen this year. But yeah, I guess my biggest wish would be good temperatures, good weather.
Yeah, good time. Well, it's not the end of July, late July. Fair will be here before we know it. It's been a great summer. We hope everybody's doing well. We know that everybody's traveling and having fun, and by God, we believe in going out and doing that. We'll stay here and take care of this part. But if you have any questions, concerns, you want to go through your portfolio, you want to hear kind of what we think is next, I please encourage you to reach out. And I thank you for taking the time to join us today. So have a great rest of the summer. We'll be seeing everybody real soon.
Thanks, guys.